Hello, everyone, and welcome to another episode of the WTFinance podcast, where we talk to experts to help gain a greater understanding about what is happening in the world of finance, investing, and markets. On today's podcast, I'm happy to welcome back Dr. Adi Imsirovic. So Adi has over 30 years of experience in oil trading, recently as global head of oil at Gazprom Marketing and Trading, which is based in the UK, and is currently a senior research fellow at the Oxford Institute for Energy Studies. So Adi, thanks again for coming back onto the podcast today.
It's great to be back, Anthony.
No problem. So we've definitely seen a very eventful period, unfortunately, in the energy markets since you were on. And I was just looking at sort of the changes in the price for oil and natural gas, and Brent is up 56%, WTI 60%, and US natural gas is up 75%. And that's in 7 or 8 months, which is quite crazy to think. So obviously, Ukraine, Russia, the unfortunate events over there has had an influence, but are there any other influences which have created this massive inflation in prices, do you think?
Well, the oil market never ceases to surprise, and that's part of being an oil trader is actually trying to be in there and actually suss it all out. But you never do, even with all my experience. I wouldn't have expected a half of these events, Russia being one of them. Russia invading Ukraine. But even before that invasion, I think that the oil market is very, very tight. Let's just take a little step back. A couple of years back, we had a massive demand shock with COVID and the lockdowns associated with dealing with COVID. So we lost some 8+ million barrels of demand, and eventually obviously had a price collapse as well. And then OPEC came back and said, okay, well, let's just get together some few other producers, and namely Russia, and come up with this OPEC plus idea. And it worked. They actually cut the output, and so the market sort of stabilized, even though obviously from a consumer point of view, it probably would have been better to have seen lower prices because it would have been easier to cope with COVID. But of course, cartel is all about maximizing revenues for the producers, and they actually managed to do that. Now, as we started coming back out of lockdown, one of the problems, Anthony, is that we've never been here before. We've never had this sort of people locked down for 2 years, and then we just don't really know what to expect. And what happened was there was a lot of pent-up demand. And people were just sitting there and thinking, gosh, I can't wait to get out and just go fishing, go on holiday, do anything. And of course, that demand expressed itself through higher sort of a product demand, particularly gasoline and so on. So we have this increased demand. We're getting back to where we were roughly in 2019, but actually supply did not come back. And just for your listeners, just some basic stuff. The oil supply is a little bit like an investment in the oil industry, and generally in sort of oil and gas industries, that it's a little bit like the Red Queen. You have to keep investing just to keep the productions the same. For example, if you don't invest a penny in the new oil production, what will happen on average, according to IEA, but it's not too bad of an estimate, about 6% of all the production will disappear, right? So you just have to keep investing just to keep production the same, let alone to increase the production. And that hasn't been the case, obviously, with very low prices in 2020 and 2021 with the recovery, we haven't seen that. So the investment really hasn't come back to the extent, and it takes time. Even in countries like the United States, and shale producers have been a little bit slow to come back. So we basically have a dichotomy of demand and supply. We sort of don't have enough supplies, and OPEC countries in particular have been rather poor, with a number of countries like Libya, outages in Libya, outages in Nigeria, and so on. So it's just demand and supply, basic picture, and we've got a very tight situation even before we got to the the Ukrainian conflict. And of course, we all know the story with that, and we can elaborate if you want on sanctions and the impact of all of that. But certainly the oil market's been fairly tight.
Yeah. So I remember last time we were talking about OPEC Plus, and you were saying that they only have about 25 or maybe 20 to 25% of the overall oil quantity. And you're saying that they can't really have that much of an impact, but it seems over the past year and a bit, they have flexed their muscles a bit, and it seems it has been working. So has anything changed since then that they can actually have an impact on prices?
Well, I mean, a couple of points there. First of all, I think it was OPEC plus and not OPEC. So Russia and other producers stepped in and used that. The curves, supply and demand curve in the oil industry are very, very inelastic. So it doesn't really take much. It takes 1 million barrel out of roughly there's about just short of 100 million barrels of demand and supply in the world. So if you take 1 million, you get a big hit. Right now, as a rule of thumb, you can just say you lose a million, you lose about $10 price will go up by about 10 bucks. So it doesn't really take much. And Saudis alone can swing a couple of million barrels there. That's $20 a barrel. So together with OPEC plus, obviously what happens if OPEC plus or if the plus part is not playing their part, what tend to happen in the past, and that's why there was a price war just beginning of 2020, when Saudis, for example, cut, and then if the Russians and others produce more and just make up for it, then there's no impact. The only thing that happens is the Saudis lose their revenue, right? But once you have these guys on, and I think that the extent of the shock in 2020, and Saudis just actually started this price war as the COVID was actually becoming apparent. So we had a double whammy, and the extent of the price fall, and if you remember WTI going negative almost $40 a barrel, the extent of that shock on everyone was so big that actually it brought everyone to heel. And all the producers said, okay, we're in, we've got to do this, right? So I think it's also the circumstances. And I have a very simple rule of thumb when I was trading, is that OPEC is always strong in a strong market and is usually weak in a weak market. When the market is strong like now, it's very easy to exert that influence. It's very hard to exert that influence when the markets get weak, because then everyone starts looking at each other over the shoulder. If I cut, will they cut? And that becomes the sort of cheating becomes a problem. But in a strong market like this one, it was quite easy.
Yeah, you could say that, because it's so tight, a few, as you mentioned, 1 million barrels here or there makes a massive difference. But when it's cheap and there's a glut of oil, you could say in sort of 2014 and before that with shale, then, as you mentioned, they don't have as much influence.
Absolutely.
Yeah, definitely. So how much potential do they have to maybe expand their production? Because I know a lot of people are saying, and I guess Biden's in Saudi Arabia. I'm not sure if he's there at the moment, but he's trying to talk to them to say, please expand. Do they have a lot of room, or is that maybe a myth?
Well, that's a tough one. I think we know roughly that UAE and Saudi Arabia, we estimate, could produce quite easily 2 million barrels extra. And that 2 million barrels could very quickly bring the prices down by $20, right? And stabilize the market, make things a little bit easier. The question is, and we know that Saudis can quite easily hit 12 million barrels production. The question is, what's never really been tested is how long they can keep that up. They can do it. We know they can do it for a month, 2, 3 months. Can they do it for 6 months, 9 months? That's a very, very difficult question. The same with UAE. And then would there be any supply disruptions if there's any production problems because you start hitting certain bottlenecks? And if you hit them, then you get serious problem. Also, when you're running that high of production, when you're close to the limit, there's always a danger that you may actually damage your wells, which is the last thing any producer wants to do, because usually you have to increase the secondary sort of injections of either gas or water and so on. So you can have all sorts of problems. So we're not quite sure, but we think that OPEC alone, right now, plus is actually becoming irrelevant, by the way. Russia is actually losing their production. They've lost almost 1 million barrels of their production. They're finding it I think they will find extremely hard to bring that production back over the next couple of years. So sort of Russian role, they can't produce even their quota at the moment. They're very unlikely to cut voluntarily because they need the revenues. So the Russian role in the plus and the whole plus in the OPEC plus has become really relevant. It begs the question, so why did the Saudis, particularly and OPEC, bother with OPEC plus? And I think the answer to that question is purely a political. It's taken Saudis decades and a pretty damaging price war in 2020 to get Russia on board. And I think they just loathe to let that go. They just want, they would like to keep that as a constant for the next decade if they can. So I think that's the thinking behind it. But there's a lot more to it. You mentioned Biden. I think with Biden's administration coming in, I think that the relationships have not been that great. I don't think bin Salman got and also called MBS got a call from Biden yet, even though he's de facto ruler. Also, I think you probably know that Biden sort of published the CIA report, which sort of puts MBS in a bit of a limelight there, which I'm sure he's not particularly happy about. And that relationship hasn't been that great. So from a political point of view, it was a very strong feeling, I think, in Saudi Arabia. Why should we help anyone, particularly the United States at the moment? So yeah, all those things have come to a head. So yeah, I mean, these sort of price increases have been a bit of a perfect storm in many respects.
Yeah, and if you think about the geopolitics, I know, US was going to Saudi Arabia, where they were trying to go to Venezuela, who recently inked a deal with Iran. So it's very complex, all these oil countries and just the geopolitics between them.
Yeah, I'm just for listeners who may not be aware why this, I mean, Iran and Venezuela are two oil producers, so how can they help each other? Venezuela produces very, very heavy types of crude oil, and very often they need to be diluted just to be even piped. Some of those grades you can literally shovel. But Iran produces quite a lot of condensates, very, very light crude oil. So Iran would bring condensates to Venezuela and use that as a diluent for some of their grades and so on. But even, I mean, we've seen the United States allowing for some Venezuelan exports. I think US is very keen because US refiners are very complex refiners. They very much like these heavy grades. And one of the reasons why US was importing Russian fuel oil, particularly a lot of Russian fuel oil and VGO, was because they had lost the Venezuelan supplies. Now, having lost Venezuelans and Russian supplies is a bit of a problem. So there are a couple of cargoes now going to Repsol and I think to Total. Already Venezuelan cargoes arriving to Europe. I guess that's all political negotiations, and it's not quite clear. It's not made public what the issues being negotiated are, and I'm sure the Venezuelan regime is playing a hardball just like the Iranian one is. But to be honest, I mean, it's look the quickest right now. Joe Biden is panicking because you've got midterm elections in November. And gasoline price seems to be, very, very important in the US. Everyone is living in their cars over there. So he's looking for buttons to press. SPR SPR is very hard to fix the price. SPR can fix, situation of shortages, not price, and it's not designed to fix the price. And it hasn't. But the sheer volume that OECD countries supplied, about 240 million barrels over a period of time, it's a massive amount of oil, and that certainly has calmed the markets a little bit. But the next button for him to press, the easiest one would be a deal with Iran and Venezuela. That really would calm the market a lot. You see, Iran is sitting on probably 100 million barrels of condensates, primarily on the water, that's not just sitting there on tankers, because the Iranian and IOC, they own a lot of shipping and they generally ship their own oils because of the history of sanctions and everything else. So if suddenly there was a deal that actually would be very, long term is not particularly helpful. Iran wouldn't be, they already export over 1 million barrels. They probably could export up to 2 million barrels, but the initial wave of this oil of 100 million barrels into the market would certainly make a big psychological dent to the oil price.
Yeah, and I think one thing that I've learned the more I've studied it is just how important the know-how and the knowledge of actually drilling for this oil and actually, taking you out of the ground, basically. And I guess you could say that's why Venezuela has struggled so much, because with the sanctions, they've struggled to get the knowledge. Iran as well, they can't really increase production. And I guess, is there a potential for Russia to go the same way? Because many of these Western countries, Shell, BP, other oil companies have left. So are they going to struggle to, as you mentioned, maintain the wells and keep the production where it is? They've already lost 1 million, as you said.
I think it's an excellent question. When it comes to conventional production, I think Russia will manage fine. I think where they're going to lose out a lot is a little bit more unconventional production up in the north, and for example in Sakhalin. Shell and Exxon are pulling out of Sakhalin, for example. Those are very complex regions for production. I think they'll struggle there. I think they will struggle up in the north, Alaska, and so on. All these new projects that were unconventional, I think, are basically not going to come on stream. So there's a number of these projects. So that will certainly impact their long-term production. I don't think it's going to impact so much their short-term production. Short-term production is primarily being impacted by, funnily enough, even before the European sanctions, by people self-sanctioning, companies and countries self-sanctioning. UK is a good example, even though it's by the end of the year. US is the other one, already sanctioned Russian imports by the end of April. But a lot of companies and even trade union organizations, there's a very good example before the UK sanctions, the dock workers of the SR refinery, they refused to accept a ship bringing Russian crude, for example. So the self-sanctioning's made a really big impact. But that's a fascinating subject. I think all these sanctions and what impact it's going to have on Russia, because it's kind of moving target. You've got, of course, countries like India loving the fact that they can now just buy heavily discounted, 30% discounts. These are big discounts. Russian crude, and the harder it is for Russia to sell the oil, the bigger those discounts will be, and more tempting will be for some other people to buy it.
Yeah, and I think we've seen that they've made a partnership with Sri Lanka, who's obviously struggling a lot with their commodities and importing. And I think at the price that we're seeing commodities at, unfortunately, a lot of these emerging countries are going to really struggle to cope. So I guess that's where Russia can maybe exert its power and to continue to export this product to those countries.
I'm not sure that's much of a power. You see, if you're trying to sell something to a country that's broke, like Sri Lanka, what are you going to do? So the way Russia is doing it, either through discounts or there's some additional stuff that they're offering, some payment terms like 90-day payments. Normally oil is sold under 30-day payment terms, to basically getting your money back later if you get it at all. So I'm not sure that's the way Russia wants to go. I mean, and another example is, Russia going east. And of course, Russian politicians are trying to make a big deal of that. But Russian gas lands at the Chinese border at some $4 per MMBTU. In Europe, when the price was a little bit higher, it's come off in the meantime, but it was landing at 40. So is that really helping you when you say, okay, we can go east, right? Well, you can't really, because east is really taxing you very, very badly for that. Plus, not to mention, if you want to export more product, oil, gas, and petroleum product east, you have to invest a lot more money, and that's not easy. And that takes time as well. Building a pipeline costs billions and billions of dollars. So it's not that straightforward. I think the obvious market in the long run for Russia would be Europe again, but that would quite clearly, require some sort of, if not regime change, then basically U-turn in the Russian sort of current policy.
Yeah, which is hard to see at the moment. So
yeah,
as you mentioned, a lot of the European countries, UK, have put sanctions on Russian energy. They're trying to do oil by the end of the year, I think. And, I guess the concern is that if Russia pulls out their gas from Europe, they're going to struggle. So is there a way that Europe could sort of wean itself off Russian hydrocarbons in the short term, or is that not possible?
Yeah. Well, I mean, you know, as I explained in my book, I think that you've got a fairly perfect international oil market. So point I tried to make in a number of talks and interviews and so on before was the usual question is like, oh, what is Europe going to do? Where are they going to get the oil from? Well, the only impact is going to be high prices that will impact everyone, and most of all, as you mentioned earlier on, Sri Lanka's and Pakistan's of this world, not to mention African countries. Europe is a wealthy part of the world. We'll just pay up and we'll get the oil that we need. Quite frankly, well, that's what we've been doing with gas as well. We just pay up and get LNG diverted from Asia into Europe. It's just a matter of money. At the end of the day, even gas market with the advent of LNG has become a lot more sophisticated. The old-fashioned sort of pipeline market is still there, but with the LNG stepping in and connecting the world, the gas market has become a lot more globalized. So again, I think what's going to happen in Europe is that they'll just already, we've seen big change in flows in the oil market. So I'll briefly mention that, might be of interest to your listeners. Obviously, grades like 40s and Johann Sverdrup, there are sort of close 40s. It's not far away from Urals, which is Russian crude in terms of quality. Those grades will just stay here and they'll go less into Asia. And then, there'll be more US imports coming to Europe and probably more West African crude coming into Europe. West African, particularly Nigerian grades, they used to go into India. Now will be coming to Europe because India is buying more Urals. So you'll have, basically you'll have inefficiency in the market because of restrictions, unfortunately. So oil will go a lot longer on ships, and you'll probably get it somewhere in Suez canals, like ships going past each other, just even though there was absolutely no need for that whatsoever. But markets work, and that will get sorted out. The gas is a lot harder for Europe, simply because of sheer volume, and particularly sort of for Western Europe, including Germany, the sheer volume of that energy that was coming. Germany has quickly to build some LNG terminals. Okay, of course there is interconnections. They can use other people's terminals, including the UK, but even those connections are imperfect under current situation. So we had a situation where MVP in the UK is a lot cheaper than TTF, and the reason is that UK has a lot of regas facilities. So you import a lot of LNG, but it's got very little storage with the closure of Rough storage. And because it's got very little storage, and the links to Europe for exporting are not as great. The other problem that Europe has is, for example, Spain has a lot of regas capacity, but actually the links through to France and then the rest of Europe are quite poor, because the last time a project for a gas line was turned down for environmental reasons, I think. So those links need to be fixed very, very quickly. So interconnectedness is one way to fight the energy security issues, both on gas, and oil, but for any other type of energy and any other commodity.
I think I read an article where I'm not sure who it was, but someone in Europe was unhappy with how much flow was actually in the gas pipes in the UK. They're saying it was too low, but then the UK was saying, we don't want to push it too far because then it could be dangerous for the whole system. So I guess that's the challenge as well.
When you have these sorts of situations, you have to watch, because we haven't been really here before. So you don't want to push the system past the limits where you're going to damage something, and then you've got a much bigger problem. But there's been a lot of confusion, obviously, in the media, these issues with given the war in Europe, and particularly given the ferocity of this war in Europe and the amount of money that Putin's been getting out of Europe for the hydrocarbons. A lot of confusion about what Europe was doing, and the flows have actually been pretty high from Russia to Europe for gas, and everyone said, well, why actually are flows even greater than before the Ukrainian war? And the simple truth is there's a lot of these term contracts, until they are phased out for one reason or the other, or force majeure through the ruble payment, we can come back to that, they are so-called take or pay contracts. So if you don't lift those molecules of gas, you'll have to pay for it anyway. And if you don't, you'll go to arbitration court and you'll lose for sure, because it's a very obvious breach of contract. So you have to do one of two things. Plus, there were, as you know, the European Union has announced that certain targets in terms of storage volumes had to be met. So that was the other reason. But eventually, those volumes will dwindle, and we see sort of semi-voluntarily that happening with the Baltic countries, with Poland phasing out their term contract for gas. And we will see that phased out with most other Western countries as well.
Yeah, well, I think what we've seen is, as you mentioned, a lot of it's coming from Asia and specifically North America as well, the gas. We did see, I think it was a explosion in one of the gas terminals in the US. Is that going to have a big impact on?
It has. I mean, it has had a big impact because we still actually don't know the full extent of the damage. It was an explosion, and basically that would, reduce the volumes coming into Europe by probably 1.5 BCM for a period of maybe about a month. So you had two effects. One effect is LNG prices going up. The other effect is actually Henry Hub prices going down.
Yeah.
Because less of the local product is finding its way out into the marketplace. So, but this is a problem when you have already a very, very tight situation. Any of these minor issues is going to be counted, and with these elasticities being so low, will have effect on prices. And one thing we can say for sure is that both oil and gas market are going to be volatile for quite some time.
Yeah, I think that's a safe bet. And one thing that I found interesting, as you mentioned there's the two different contracts, obviously in the US and Europe. And the US, because they have a glut of gas, they were quite low, but they're quite a lower price in Europe. But now we've seen they're sort of converging because a lot of that gas is being exported to Europe. It's almost like the arbitrage opportunity of getting more over there. But now that there's less going over, it's going to be cheaper in the US. It might be better for Biden potentially as well, because energy prices are going to go down.
Yeah, possibly. But the economics work at the end of the day. There'll be new terminals, new trains coming, coming along. When you have this big difference of Henry Hub being $9 and Europe being at $30+, the obvious thing is to export, and there will always be that pull, and that's what markets do. That's what markets are good at. They tell you what the good opportunities are. So hopefully that will incentivize the American shale producers to actually step up and produce a little bit more.
Yeah, someone I talked to recently was saying that the real thing that needs to happen is American shale to really increase their production, because that's especially if you want to start transitioning to renewable energies, gas is really going to be the vital aspect of that.
No, absolutely. I mean, there's been a lot of talk, and I think it's a very interesting subject why that shale production is not reacting as quickly as it used to. And all the good points are valid. Yes, they want to improve their cash flows. Yes, there's less investment coming from the Wall Street. They're less prepared to throw money at the companies and just hope that someday in future they'll get their money back. But I'm also a little bit cynical. There's been a lot of market concentration. I tend to, one of my key arguments that I wrote in my book, and it's just my experience in the oil market, it's been that market concentration gives you a lot of answers to a lot of questions about price. So there's been an increase in market concentration, and you see, if you actually look at Fed Dallas Fed actually data, and some interesting research on that, you've got private companies, they're investing far more into production compared to public companies. And the difference is private companies are catering for the owners of those companies that really want to get real economics and money. And if they get it in 2 or 3 years' time, as long as they maximize it, that's fine. With public companies, they really run by, and this is where I'm getting cynical about sort of modern state, this modern sort of public sort of company capitalism, where the managers, they all have share options, and they basically first and foremost want to prop up the values of those shares so they can benefit themselves. And it's very easy to do that by saying, well, we want to improve the shareholder value, but really they're propping up their own value. Shareholder value long term would be much better served if they increase to these levels. For example, the Dallas Fed is showing right now that even the most expensive new wells, that's a marginal cost of those ones about $70. With the current TI prices, I mean, those are massive returns. Why not invest? It's crazy not to invest. But this idea of supporting shareholder value just doesn't fly for me. The too many big companies like that, the sort of the Exxons and Chevrons of this world that don't probably even hedge most of their production. And they make these sort of semi-communist decisions at the board level. So I'm a little bit cynical. I prefer the old-fashioned sort of competitive capitalism where private companies go in actually and they really invest, they take risks, and those are the companies that brought the shale production to what it was.
I guess you could say they were also the companies who really struggled once there was like a glut of oil, and maybe they've been affected by that, by the past results. I think it was, I'm not sure the date, 2015, 2016, where there was a lot of people who lost a lot of money because oil and I guess gas was so low. So,
but that's the investors, when Wall Street was throwing money at these guys, and of course they became a little bit lax, and they just had so much money that they could deal with. There's the other problem was also lack of a risk management. If you think about shale production reminds you very much actually also of these retail companies in the UK that provided energy. That sort of risk management, when times are good, a lot of managers tend to say, okay, everything's fine, let's take even more risk. In shale, you don't have to take that much risk because you're basically, your time horizons are rather short. So you're basically saying, I need $10 million for this horizontal well. It'll produce that much, I know pretty well, and you can actually hedge that production for a year right away. So your cash flow and your returns can be managed reasonably well. So why the company's doing too well? I mean, it's very individual. There are big differences between them, but most of them were just like, saying, okay, I don't want to hedge at these levels, it's too low. Well, that's not proper risk management. You can't say that. You're basically taking a punt on the sort of market price. And similar situation happened in the UK with, some people are just selling these fixed price products, and not hedging, and you can't do that. And obviously there was a very poor oversight. So these companies, instead of being like your local retail groceries, they were essentially, that was what they were meant to be, big companies supplying, they would buy and cover the retail level and have a retail margin, just like your local supermarket. Instead of that, they were selling these fixed price contracts, not hedging it, and basically going bust. And that's what happened.
Yeah, I think Bulb was the one that went bust, and they only had a 6-month hedging limit, which is crazy to think. Like, for a company that has so many customers and needs so much energy, it's crazy.
Well, it's very simple. If you've got one customer, like, you come to a retail guy like that, and you as soon as you fix a price for a two-year contract, for example, you go and hedge 2 years. As simple as that. You can't go and hedge for 6 months. Of course, there are in some markets the liquidity for 2-year contracts is not there, and as you will learn in your new job very soon, what you do, there are techniques to do that. So you basically hedge the front and you roll your hedges back, so you're still pretty well protected. There are ways to do that. There's no excuses. So essentially, what they were doing, they were being betting shops rather than local groceries.
Yeah, unfortunately, it's asymmetrical risk for them. If they get it right, they make lots of money. If they get it wrong, they just walk away. And that's the issue, isn't it?
And the issue is obviously then with the governments, what the governments do. And I was arguing very, loudly, don't bail them out. You can't bail out people like that. They go bust. But they shouldn't have gone bust either, because they should have been supervised, because that was not their job. They were not there to do that sort of thing. But
yeah, that's the issue. These are a lot of these energy companies in the UK are basically like hedge funds. And it's what we said there. They hope that it that they're making lots of money. If they don't, they just walk away and the customer's out of pocket.
Andre, obviously it works when you're sometimes so big. And that's basically why we had subprime situation. I mean, it could happen with energy. That's why I have a problem with concentration of market power in any market, let alone energy markets. Because when you become so big, you become too big to fail. And then you're sitting pretty. You can take big bets and knowing that either you're going to make a lot of money or the government will come and bail you out. So it becomes a moral risk.
Yeah, I think it's ridiculous. So if we look at, we've talked a lot about how high energy prices are, market efficiencies. What level do you think the price has to go to, I guess, in oil and gas, where we might see demand destruction because people can't afford it? I'm not sure if you've seen any research on that or.
I've actually I've actually tweeted this morning. There was an article in Financial Times saying that now most economists expect, they did a poll of a number of economists in the US, and most American economists expect next year US economy to go into recession. So that's your demand destruction. That's how it happens. And one thing that I've been saying for a while now is that I know it's very political in that they may not care, but I think OPEC is really making a very bad decision by not supplying even extra oil. I think they're running a risk. I think a lot of them are just too young to remember '86, when the market crashed completely and they just couldn't do anything about it. Saudi Arabia was a swing producer. They couldn't manage it even on their own. They're losing several $100 million per day in revenues and simply could not control the market. And what happened was exactly the same. Following the 79 price rises, when some of the countries, even in spite of the Iranian revolution, they actually cut their production further. Oil prices went through the roof. And simply most of the international community just said, look, we just can't afford this, and we don't want to. And the demand collapsed. And following that, then production came back, and basically the oil price collapsed. And these booms and busts are completely unnecessary in the oil industry. I think they can be managed, but as long as OPEC manages just one side of things, i.e. protecting their their revenues rather than saying, okay, we need to look after their customers, I think this is going to happen. The other thing is that I think you'll speed up energy transition. Very short term, there will be problems. There will be some more coal burning and so on. But these high prices will definitely, I mean, to be honest with you, why would anyone want to buy another diesel car? My next car is definitely going to be, my wife very close to buying an EV. My own next car is definitely going to be an EV. And let's move on from this, supporting despots and mullahs, in getting rich. Do we need that? And I think most people are seeing that. And it's not, I mean, gas should be transitional fuel. I'm still quite positive about gas, but even gas is getting a bad picture, getting a bad press because of a lot of leakages. Now with increase in production, there's going to be even more leakages. And I think a lot of coming to the very important point of energy transition, I think I don't even worry about, there's a lot of studies out there saying, okay, demand is going to be here, demand is going to be there. I actually think our mindset is completely wrong. I was at a conference 3 weeks ago in London, very high level conference, some amazing brains out there, and people are saying, oh, well, we believe, some people say we believe that demand is going to maintain or probably go even above 100 million barrels. I actually have a problem with that mindset. I don't care I don't know where the demand is going to be, but we know that this planet is getting fried, okay, to put it mildly. By 35 and 50, we have to drastically reduce our greenhouse gases, meet net zero targets. We know there are different paths to reach it, but we know in all of those paths, oil demand has to fall and fall dramatically. So what we need to do is actually go backwards. If you remember your economics classes and you have, a series of equations that you have to solve, you basically have to have some sort of boundary condition. And to me, what we need to get to is the boundary condition, and what we need to do in terms of energy transition is to resolve those sets of equations and say, this is how we're going to do it. And it just tells me that most of the oil industry and oil and gas industry still have that mindset, oh, no, there is, it's too difficult, it's too expensive, it's too unreasonable. There's nothing unreasonable about trying to make sure, hopefully we will make sure that this planet doesn't get fried in 50 years' time, and that we leave something for future generations rather than just destroy it ourselves. So I think that's a very interesting point, I think, for most of the industry to start thinking about, that we just have to get there and start thinking backwards. And there'll be need for oil for a long time to come. There'll still, I think, Gulf oil producers will be almost certainly in the driving seat because that concentration of power will increase. But they will also realize there'll be a lot less demand to meet. And I think the sooner they start thinking, the sooner, not just they, but everyone in the industry start thinking that way, there will be a industry for the next 20 years. But the way they're going now is just being a little bit irresponsible, I think.
Yeah, well, I think Saudi Arabia is one of the largest investors in Lucid Motors. I think they own like 60% of it. So I guess they are thinking about the future, and as you mentioned, it is vital to think about this transitioning of it. And do you see nuclear being a massive factor as well? Because I guess the challenge with a lot of renewable energy is it's intermittent, whereas nuclear is consistent.
Nuclear is very, very important. I think nuclear has a slightly different problem. First of all, it's very extremely expensive, and it's expensive for a number of reasons. We can have a whole new podcast about that. It's the state intervention, this and that, and various regulations and so on. The problem with nuclear, I think the key to understand right now, we have to act now quickly. The key is to keep those nuclear plants that are safe in operation for as long as we can until we reach that energy transition. And that's something that, a lot of people just don't get. Japan is a very good example. They've been taking forever since the Fukushima disaster to bring these nukes back. It's ridiculous. France is struggling. So clearly the nuclear industry hasn't been either operated under a proper sort of supervision or mode or whatever. And so because of all that, there is a lot of mistrust among the population. So you see in Germany, they're still shutting them in spite of the need to, especially because, yes, nuclear doesn't directly compete with oil or gas, but with gas it does, because gas is very important for electricity or power generation. So as a result, now they're burning lignite. So I think it's very important to keep the ones that we have. California, for example, is another good example. Why close the nukes there if they could be running for another 20, 30 years? UK has already made a decision. They do want to keep the existing ones as long as they can. And I think it's the right policy. Now, the new nuclear plants, what are our options? I think at the moment, from a technological point of view, we don't really have too many options, I'm afraid. Yes, I would like to see a lot more onshore and offshore wind. I'd like to see few, PV cells on every roof if possible. But we're still, I think we're going to struggle with intermittency, especially in places like Northwest Europe. So we will definitely need nuclear and gas to be there. Nuclear is not ideal spinning capacity, but at least we know that it can supply a good chunk of energy that we need. And it's going to get harder and harder. The more wind and solar we have, the harder it will be, or more expensive it will be to run that spinning capacity. Because if you're running a gas turbine only a few hours a week, that gas turbine is going to cost you a fortune. And very often that cost is not taken into account when people talk about the cost of renewable energy like wind and solar. It should be taken into account because that makes it a lot more expensive. But I still think we can achieve it. that transition, and I think nuclear will play a very important part.
Yeah, I think one thing I talked to someone recently, and they were saying that just the amount of upfront, if you think of energy as almost like money, to bring a lot of this renewable energy into play, you need to invest a lot of money and energy into actually producing it. And I think that's one thing that really resonated with me. It's like, hang on, we actually need to continue with energy, and it's going to take, to produce this is actually going to take our current energy use as well. So we need to, in my opinion, we need to go quite heavily into gas in the short term for the next 5 or 10 years. And then from there, continue to increase renewable energy solutions. And hopefully we can then transition fully and maybe go into nuclear as well.
I think one of the important things that I wrote about recently, not recently, a few months ago, that the problem with transition that we have is also, we do have a political problem. And our political problem is our political systems are very short-term oriented. Okay, so you make all these promises, but in a couple of years you probably won't be there. So who cares? And also politicians tend to like decisions that are good for them, for the votes. Unfortunately, most of the electorate doesn't really understand these issues that are way too complex. So what's been happening in the last few years as a part of this energy transition, the government's been very, very good at hitting at the supply side of the energy and not doing anything about the demand side. Why? Demand side is the votes. So let demand grow and flourish and let people have ideally cheap energy if they can, because that brings you votes. The supply side is a lot easier because you're hitting the big unfriendly oil companies and gas people, and they're all rich. And you heard what Biden was saying, that Exxon makes more money than God. But he didn't mention Apple or Google or Alphabet. They're making far more money than that. And as soon as they make some money, one of the points, for example, I was making is that these, big oil companies, they have been shutting refineries for years because they haven't been making money. For decades, they haven't been making money. And a lot of these refineries, especially in Europe and US, are old and they needed hundreds of millions of new investment. And why would you do that if in 10 years' time we need to reach net zero targets, right? So, and suddenly now, oh my God, petrol or gasoline is $5. Well, that's all part of that. You don't want to allow new pipelines like Keystone Pipeline. Well, what do you think is going to happen with energy prices? If you don't allow new refineries, if you don't allow new drilling on federal lands, what do you think? So they've been hitting the supply side of things. And basic 101 economics is, if you have less supply and you let demand grow unchecked, you're going to have high prices. So right now, this energy transition is going to be associated with very, very high prices because our political system hasn't been good enough to adjust a demand side of things. And what do I mean by demand side of things? In the United States, there's no carbon tax. So you want cheap gasoline for everyone. Well, when it's cheap, demand will keep growing, right? If you want to actually choke supply, you have to choke demand as well. I mean, I'm talking about fossil fuels, not energy in total. So you have to choke demand as well for fossil fuels. The easiest and simplest way, as you know, in economics, the most efficient way to do it is through carbon tax. But they wouldn't do it because it's not good for the votes. And it's hugely disappointing. As an economist, you're sitting there thinking like, oh my God, we've got price caps in Europe, we've got subsidies. We had all of this in the 1970s and it brought us nothing but a disaster and higher prices later on. Because if I'm a consumer and you start reducing tax on gasoline or petrol or diesel, well, I'm just going to keep on consuming. There won't be that demand destruction. And if it's wasted, I'll still keep on doing. Well, who cares? I just went past, coming back into the house, there were people sitting in the car at least for about 15 minutes and they were texting and the engine was on. And I'm thinking like, who said that gasoline was expensive? If you don't, and if you keep subsidizing that to gain votes, what's going to happen? It will just have higher prices later on. As energy crises will sort of keep on rolling, you won't get resolved.
Yeah, I think as you said, energy prices will keep going up, but then these big companies won't invest because they're concerned about the political rhetoric. So it's almost heading for disaster, isn't it?
Yeah, well, I don't know. I wouldn't be.
Hopefully not.
It's not that. No, what I would say is, as I said in my tweet this morning, I think you can see the demand destruction starting already. If you get recession in the US, and we know the US, when US sneezes, everyone else catches cold. There'll be less. It's not good news for China. It's not good news for Europe. It's not good news for Africa or Asia. It's not good news for anyone. If we go into recession, it's not good news for OPEC as well. So what will happen? We go into recession. I think actually I'm one of these. I'm totally in disagreement with Goldman Sachs and a number of people out there talk about $150 oil. I think we could have spikes, but I think the demand destruction is already happening. I think that's why partly we saw as soon as Shanghai starts noticing further cases in COVID, oil market reacts because Shanghai alone has population of Australia. Okay, so that's when China sort of sneezes. I think everyone else has to start catching the cold, including commodity markets. So we know, Anthony, that interest rates have to go up. We know that. We know where inflation is. As economists, we know where the Fed and everyone else has to go with interest rates. If you want to go and buy Bitcoin, well, good luck. Okay, and if you think that oil is going to prosper in an environment of high interest rates, you're wrong, because interest rates are not good for commodities. Okay, now I understand the market is tight at the moment. We still have geopolitical events. We can still have Libya. Oil will rally, but actually looking longer term, the more I think about it, I think that the more I'm inclined to see sort of in 2 or 3 years' time some major price collapse in oil rather than prices going up and up and up.
And as you mentioned, once the price starts going down, a lot of these OPEC countries start freaking out, overproducing, and it almost exacerbates the issue. Absolutely,
because you need the revenue. I mean, countries like Russia is a very good example. Actually, it's a very bad example. There's no mention, or I don't think Putin's ever really talked about seriously about environment at all, even though Russia will probably be very hard hit. All emphasis on short-termism for Russia. Oil and gas are basically like a printing press. You print money in a printing press, and why wouldn't you just print it? You don't care, the cost is just sunk anyway, so you just print as much as you can. So when the prices go down, there will, some of these OPEC producers, again, and OPEC's done that before, and other producers as well, they will just produce more to keep the revenue and the budget there. And then, you get strong OPEC and strong markets and weak OPEC and weak markets situation. And I'm afraid it's likely to happen.
Yeah, and I think Russia has quite a low cost of oil production. So I guess that's why they produce it as well. So Adi, I'm sure I could talk hours with you, yes, I think, about all this stuff, but thank you so much for joining the podcast. And just my last question, what is one message you'd like viewers to take away from our interview?
From interview as in energy, or what they would like to do in future? Or
just energy or anything, I guess, whatever you think.
Sure. No, listen, guys. Energy is extremely important. I understand your podcast is more for sort of economics, finance, sort of people, markets people. Look at market-related ways to help the energy transition. I think next 20 years is going to be the key. I think we have to, and I despair sometimes some of the people, my peers and my colleagues, they're still kind of in that old-fashioned mode of the oil industry, drill, baby, drill, and you don't understand, we need this gas, we can't do it. We need to change, and just please work on the change. We need this transition to happen as quickly as possible.
Yeah, it's very important. And so if anyone wanted to keep up to date with your work, I know you're very active on Twitter. Would that be the best place?
Adi at Adi Sari Energy, yes. And then you can always look me up on the OIES, Oxford Institute for Energy Studies, for any new publications or my colleagues' publications. It's free downloads, so you can have those downloaded for free. On the Twitter, I would normally announce any new publication that I do. So Twitter is probably the best one.
Yeah, perfect. I'll pull that all in the description below. So Adi, thanks again.
You're welcome. All the best.
Thank you so much for listening. And if you enjoyed the episode, please subscribe and click the bell icon so you are notified when new podcasts are released. I hope you're leaving with some great value about investing, trading, and finance. See you on the next show.